Most people believe the top 1% stays wealthy by earning higher returns. That belief is wrong. They stay wealthy by avoiding risks most people never even see. What we usually hear about money focuses on growth. Stocks going up, new opportunities, the next big investment. But at the very top of the system, the goal is different. It is not about getting rich. It is about staying in control. So what is the real financial strategy used by the top 1%? First, let's clear up a misunderstanding. The wealthiest households in the United States and globally do not behave like aggressive investors. They are not constantly trading. They are not chasing trends. And they are not relying on salaries, even very high ones. Their primary concern is stability. That matters because once wealth reaches a certain size, growth becomes secondary. Loss becomes the real enemy. A 10% loss on a small portfolio is painful. A 10% loss on a billion-dollar structure changes power, influence, and long-term control. This is where the real strategy begins. The first pillar is asset protection, not returns. For most people, investing is about maximizing gains. For the top 1%, it is about minimizing exposure. Legal structures matter more than performance. Trusts, holding companies, and layered ownership are designed to isolate risk. If one asset fails, the rest remain protected. This is not about hiding money. It is about preventing single points of failure. In the US, this shows up through family offices, estate planning, and liability separation. Globally, it appears through jurisdictional diversification and legal redundancy. The key idea is simple. You cannot lose what you never fully expose. The second pillar is time. The top 1% operates on timelines that most people cannot afford. 20 years, 30 years, sometimes longer. They are rarely forced to sell. They do not need liquidity to survive market downturns, and they are not pressured by short-term income needs. This allows compounding to work without interruption. No panic selling, no forced exits, no emotional decisions. In the US market, this explains why downturns often increase concentration of wealth. Those who can wait benefit from volatility. Those who cannot are pushed out. Time is not just an advantage. It is the advantage. The third pillar is control over liquidity. Liquidity is often described as a strength, but for the top 1%, too much liquidity creates exposure. Public markets move fast. They react to news, sentiment, and speculation. Private assets move slowly and quietly. This is why large pools of wealth favor private equity, real assets, infrastructure, and long-term ownership stakes. These assets are harder to sell, but also harder to destabilize. Control matters more than flexibility. Owning part of a business, land, or infrastructure creates influence that daily price movements cannot erase. This is not about secrecy. It is about insulation. The fourth pillar is systems, not hustle. At the top, wealth is not managed by individuals making decisions alone. It is managed by systems. Family offices coordinate investments, taxes, legal planning, and succession. Decisions are structured, reviewed, and adjusted over time. This removes emotion from financial management. It also removes urgency. In contrast, most people interact with money in fragments. A bank account here, a retirement account there, a loan on top. The difference is not intelligence. It is architecture. So why is this strategy mostly invisible? Because the financial media does not focus on structure. It focuses on performance. Returns are easy to compare. Systems are not. Most financial products are designed to be sold, not explained. They emphasize access, speed, and opportunity. They rarely emphasize long-term protection or downside control. There is also a cultural factor. In the US especially, financial success is often framed as effort and skill. But the reality is that stability itself is a resource. The more stable your position, the more risk you can safely avoid, and the less visible your strategy becomes. This leads to a larger system-level insight. The modern financial system rewards those who already have stability. Volatility is absorbed at the top and transmitted downward. Market shocks hit workers, borrowers, and renters first. Owners and controllers experience delay, cushioning, or insulation. This is why financial inequality is not just about income. It is about who can afford stability in an unstable system. As global uncertainty increases, this gap becomes more important. Higher interest rates, geopolitical risk, supply chain disruptions, political polarization, all of these increase volatility. And volatility does not affect everyone equally. Those with protective systems adjust. Those without are forced to react. This is why the real strategy of the top 1% is rarely discussed. It is not exciting. It does not promise quick results. And it cannot be easily replicated without stability to begin with. But it explains a great deal about how wealth persists. So what should we watch next? As economic pressure rises, the divide will not be between people who earn more and people who earn less. It will be between those who can build stability into the system and those who cannot. And that difference will shape the future of money, power, and control. Thanks for watching. If you found this useful, subscribe to Systems Watch for clear, calm explanations of how money, power, and global systems really work.